Welcome back to the channel. Today we're talking about a newly listed name in the healthcare sector, NephroCare Health Services. It's trading near $4.75, and investors are wondering, is this just IPO hype or a solid long-term compounder? Let's break it down. NephroCare operates India's largest organized dialysis network, offering renal care services across partner hospitals. Instead of building its own infrastructure, it follows an asset-light model, setting up dialysis centers inside existing hospitals on a revenue-sharing basis. This keeps capital needs low, allows faster expansion, and improves scalability. Now, dialysis is not optional treatment. Patients come 2 to 3 times every week, often for years. So this business naturally creates recurring revenue, high patient stickiness, and predictable cash flows. That's why globally, dialysis is considered an annuity-like healthcare model. Let's look at the numbers. The stock's market cap is around 4,700 crore, and valuation is steep, roughly 70 times earnings. Clearly, this isn't a cheap stock. Financials show steady revenue growth driven by new centers and rising utilization. But margins, while stable, aren't very high because this is a service-heavy business. Costs for staff, consumables, and maintenance stay meaningful. Debt is comfortable, and cash flows are steady given repeat patient visits. Structurally, it's a stable, non-cyclical business, not tied to economic ups and downs. Dialysis demand only rises with India's aging population, diabetes, and hypertension cases. That forms a long growth runway. The company's asset-light model improves return ratios over time, and hospital partnerships create strong entry barriers for new players. Now, the flip side, valuation risk. At 70 times earnings, the market is already expecting strong growth, smooth execution, and stable margins. Any hiccup in profitability, center expansion, or cost control can trigger a correction. Regulatory risks also exist. Pricing for dialysis can be influenced by government reimbursement policies. And while the model is asset-light, the company still needs continuous capex to expand. If utilization of new centers lags, ROCE could stay under pressure for a while. On the technical side, price is consolidating near $4.75. Support lies between $4.40 and $4.55. While resistance is around $500, a breakout above $500 with strong volume may open the door for higher levels, but until then, the stock may stay range-bound. So what's the strategy? For short-term traders, avoid chasing near $4.75 to $500. Wait for a confirmed breakout before entering. For long-term investors, NephroCare is a quality business in a defensive sector, but valuations are rich. The smart approach is gradual accumulation on dips near $4.40 to $4.80, with a 1 to 3 year perspective. Track center additions and earnings growth while staying patient. In short, NephroCare Health Services is a high-quality, stable healthcare compounder, but not a cheap one. It's a good business priced for perfection. Here, disciplined buying will reward you more than excitement. If you found this breakdown helpful, hit like, subscribe for more calm, data-driven stock analysis, and tell me in the comments, will you buy NephroCare now or wait for better levels?